Okay, let's dive right into this explainer. Today, we're putting on our quantitative finance journalist hats to pull back the curtain on something truly fascinating. We're going to deconstruct a massive, multi-agent AI trading simulation focused entirely on Intel. This isn't just some basic, buy or sell signal. We are looking at a complex matrix where different artificial intelligence agents, each with distinct risk profiles and analytical roles, literally debated Intel's future.
Here is our system diagnostic agenda for today. We're going to start with the breakout setup, then run through a strict technical indicator checklist. After that, we'll hit the fundamental reality, dive into the bull versus bear synthesis matrix, break down the actual agent debate, and finally, lay out the concrete execution plan.
All right, let's kick things off with Module 1, the INTC breakout set.
To really understand what triggered this whole simulation into action, look at the sheer scale of this move. Intel's price absolutely rocketed from 66.88 in late April to a close of 99.62 on May 1st. We're talking about a near-vertical 97.7% 30-day gain. A move of that magnitude forces any sophisticated trading desk to step back and ask, is this a structural re-rating of the entire company or just a crowded momentum trade that's about to violently collapse?
Let's look under the hood. Moving to Module 2, the strict technical indicator checklist.
As market technicians, we have to look at the exact parameters the desk is evaluating. With a close of 99.62, the stock is drastically extended far above its 10-day exponential moving average, which is sitting way down at 83.81. Now, the longer-term trends look undeniably healthy, right? It's trading well above both the 50-day simple moving average at 55.61 and the 200-day at 40.16, plus the MACD is sitting at 11.32, which shows powerful, accelerating momentum expansion. But guys, that massive gap between the current price and the Fast 10 EMA is a glaring warning sign of extreme short-term overextension.
And that brings us to the exact trading implications and risk warnings. While the primary trend here is bullish, the risk parameters are flashing bright red. The RSI has hit a scorching 87.48. That signals an extreme overbought condition and huge short-term exhaustion risk. Furthermore, the average true range, the ATR, has expanded sharply to 492. What does that mean for us in practice? It means daily price swings are getting incredibly violent. The strict rule here is, if you're taking fresh entries, your stop losses absolutely must be set significantly wider so you don't get chopped out, and your position sizing should be proportionally smaller to manage that exact volatility risk.
Okay, stripping away that technical momentum, we hit Module 3, the fundamental valuation breakdown.
Why is this stock being treated like a premium AI-adjacent franchise instead of a value trap? Well, the simulated bulls point to top-line revenue finally stabilizing at scale. You can see it hovering tightly in the mid-12 to $13 billion range, recently ticking up to $13.58 billion. They view this revenue stabilization, along with potential EPS buyback accretion, as the crucial first step before any real operating leverage kicks in.
But let's look at the bearish reality check. Despite the whole strategic AI optionality and foundry ecosystem narrative, the company is still wildly capital-intensive. They're burning massive amounts of cash, posting a latest quarterly free cash flow of negative $2.54 billion, driven by heavy capex of over $3.6 billion. Add in a negative trailing EPS of 60 cents, and it's clear this is a business funding a very expensive transition, not one printing free cash. And here is an incredibly important fundamental nuance regarding the return on equity. You see an ROE of negative 2.9%, but you have to realize that metrics like this can be artificially inflated by aggressive share repurchases that shrink the equity denominator. Yet, in reality, outstanding shares have actually ballooned to over 5 billion. The dilution factor means you're paying a painfully rich forward PE of 66.8. You're paying a massive premium multiple, while equity dilution reduces how much of that optimism actually flows down to you, the shareholder.
Let's pit these views directly against each other in Module 4, the bull versus bear synthesis matrix. We are going to stage a strict cross-examination between the bull and bear researcher agents. On the left, we've got the bull championing the long-term vision, and on the right, the bear relentlessly attacking the near-term financial reality. We're giving both sides equal depth here so you can see exactly what the trading desk was wrestling with.
Our bull analyst argues that markets price future trajectories, not static past values. They champion the potential for future free cash flow, the EPS buyback accretion, and most importantly, structural ecosystem lock-in. They lean heavily on recent regulatory clearance for Intel's Sambanova investment, and the CEO joining PsiQuantum's board is absolute proof of deep tech relevance. To the bull, the de-risking balance sheet and institutional-grade accumulation completely justify paying up for an AI platform turnaround.
But the bear analyst counterattacks beautifully. They point out that smartphone and legacy PC demand remain totally saturated. The bear argues that a negative working capital structure makes this a terrible setup. Asking investors to swallow premium multiple expansion risk for a turnaround with noisy earnings is dangerous. Plus, they highlight the diminishing marginal utility of stock buybacks when you're executing them at these premium prices. Strategic optionality, simply put, is not cash flow.
So how is this resolved? Let's funnel down to Module 5, Deconstruct the Agent Debate.
We're going to walk through this tier by tier so you understand the exact thought process of the simulated desk. First, the aggressive analyst. This agent championed the momentum thesis and pushed hard for a buy. They were mesmerized by the sheer velocity of the price action, explicitly pointing out the MACD surging to 11.32 and the stock holding firmly well above the 50 SMA. To the aggressive view, this is evidence of a structural re-rating, and you just do not step in front of a freight train. But then the conservative analyst steps in with rigid valuation objections. This agent cited the extreme RSI of 87.48 and an expanded beta of 2.19, warning that the stock was stretched dangerously far above the fast 10 EMA. They objected rigidly because fundamental recovery remains totally unvalidated by trailing profitability. Their core argument: we are on a high volatility regime that is extremely vulnerable to a sharp, violent mean reversion.
Finally, the neutral analyst and portfolio manager stepped in to reconcile the debate. They acknowledged the constructive trends the aggressive agent saw, but ultimately agreed with the conservative agent's risk view. They reconciled the arguments by determining that the poor, asymmetric entry quality at these stretched levels far outweighs the momentum FOMO. This secured the final underweight/hold stance, favoring a highly gradual buy setup instead of diving in head first.
So, what do we actually do with this? Moving to Module 6, Actionable Trade Execution Plan.
The desk extracted a concrete, multi-tranche execution blueprint. Step 1. Trim existing positions right into this current near-vertical strength. Step 2. Target a below-benchmark position size, then they wait. The plan is to initiate a starter position and begin layering in on dips toward the low to mid-80s, right where that 10 EMA sits. Finally, prepare for aggressive buying only near the structural breakout support lines.
Crucially, they established a strict risk management architecture with a target price horizon of 3 to 6 months. While they're looking to buy that structural support retest, they set a hard, non-negotiable invalidation trigger. If the stock decisively breaks below the 50-day moving average near 55.61, the entire bullish thesis over that 3 to 6 month horizon is completely negated and the trade is killed.
As you digest this explainer's breakdown of the matrix, you have to ask yourself a tough question. When you look at those expanding share counts and negative cash flows, is Intel's strategic optionality actually worth the near-term volatility risk? Or is this AI turnaround already priced to absolute perfection? Keep learning, keep analyzing, and I'll catch you in the next explainer.